In the 1800s, trading was a complex and dynamic process shaped by technological advancements, geographical limitations, and economic systems of the time. Trading, both local and international, involved a variety of methods and practices that reflected the era's economic and social conditions. The global trading system in the 19th century was marked by the dominance of maritime trade, facilitated by the age of exploration and colonization that had begun in earlier centuries. By the 1800s, countries across the world were linked by an extensive network of sea routes. The development of steamships and improvements in navigation techniques revolutionized maritime trade, making it faster and more reliable compared to the sail-powered ships of the past. Maritime trade routes were crucial for the exchange of goods. Major trading hubs included ports in Europe, such as London, Liverpool, and Rotterdam, as well as cities in Asia and the Americas. Goods transported across these routes included raw materials like cotton, sugar, and coffee, as well as manufactured products like textiles and machinery. The global trade network was supported by colonial empires that provided both resources and markets for goods. Trade within Europe was similarly active, with the continent divided into numerous states and principalities, each with its own trade policies and economic interests. The development of railroads and canals during the 19th century significantly boosted trade by providing more efficient overland transport. Railways, in particular, allowed for the rapid movement of goods and people, linking industrial centers with agricultural regions and ports. The Industrial Revolution, which began in the late 18th century and continued into the 19th, had a profound impact on trade. It led to the mass production of goods, which increased the volume of trade and expanded markets. Factories produced textiles, iron, and other goods on a scale previously unimaginable, and the invention of new machinery and production techniques reduced costs and increased efficiency. Economic theories of the time, such as those proposed by Adam Smith and David Ricardo, also influenced trade practices. Smith's ideas on free markets and competition, along with Ricardo's theory of comparative advantage, shaped trade policies and practices by advocating for less government intervention and more open trade between nations. Trade policies varied greatly between countries. In some places, mercantilist policies persisted, where governments sought to maximize exports and minimize imports to build national wealth. In contrast, other regions embraced more liberal trade practices, reducing tariffs and barriers to encourage trade. The British Empire, with its extensive colonial holdings and naval power, played a dominant role in promoting free trade and establishing global trading norms. Local trade was also vital, with markets and fairs serving as focal points for the exchange of goods. In rural areas, local farmers and craftsmen traded their produce and goods at these markets, which played a central role in the local economy. Urban centers became bustling trade hubs, with specialized markets for different types of goods, from fresh produce to luxury items. Despite these advancements, trading in the 1800s faced numerous challenges. Transportation was still relatively slow and subject to disruptions, such as adverse weather conditions or political conflicts. Furthermore, trade was often impacted by colonialism and the associated conflicts, which could disrupt supply chains and affect market stability. The legal and financial aspects of trade were also evolving. Credit systems and financial institutions developed to facilitate trade, including banks and insurance companies that provided services to mitigate risks associated with shipping and trade. These institutions played a crucial role in supporting the expansion of international trade by offering financing and managing risks. Overall, trading in the 1800s was characterized by a dynamic interplay of technological progress, economic theories, and evolving trade policies. The period marked a transition from traditional trade practices to a more modern and interconnected global trading system, laying the groundwork for the economic developments of the 20th century. Trading was influenced by a range of factors, including technological advancements, geographical constraints, and evolving economic theories. The global trading system was deeply intertwined with the age of exploration and colonization that began earlier. By the 19th century, maritime trade routes had expanded significantly, connecting various parts of the world. The advent of steamships and improved navigation techniques marked a significant shift from the reliance on sail-powered vessels, allowing for faster and more reliable voyages. This technological progress reduced the time needed for maritime journeys and made shipping schedules more predictable. Steamships also had a greater cargo capacity, enabling the transport of larger quantities of goods. This advancement contributed to a more efficient global trading system, as goods could be moved more rapidly between regions. On land, the expansion of railroads revolutionized trade by connecting industrial centers with agricultural regions and ports. The construction of major rail networks in the United States, Europe, and Asia facilitated quicker and cheaper movement of goods, further integrating regional economies and enhancing trade efficiency. Communication improvements also played a crucial role in shaping trade during this period. The telegraph, invented by Samuel Morse in the 1830s, transformed long-distance communication, allowing for almost instantaneous transmission of messages. This innovation was particularly important for managing trade operations and coordinating the movement of goods across vast distances. Traders could now receive real-time updates on shipping conditions, market prices, and political developments, enabling them to make more informed decisions and react swiftly to changes in the market. Later, the invention of the telephone by Alexander Graham Bell further enhanced communication, although its widespread use did not occur until the late 1800s. Both the telegraph and telephone facilitated a more interconnected global economy by making it easier for traders to establish and maintain business relationships, thereby improving the efficiency of international trade. Economic theories and policies of the 19th century had a significant impact on trading practices. Classical economists such as Adam Smith and David Ricardo advocated for free markets and minimal government intervention. Their ideas on free trade and comparative advantage promoted the reduction of tariffs and trade barriers, encouraging more open international trade.